All right. It's short time. It's about that time. The most awaited moment is here. Thank you guys for joining the call. I believe we are all ready for today. So please, before we proceed, I'd like to know if you guys can hear me clearly. Just type on the chat section if you guys can hear me. Give me a thumbs up. Let me know if you guys can hear us. Okay. Let me know on the chat section. Let me know if you guys can hear us before we get started. Before we get started. And also, I'd like to know, where are you listening us from? Which region are you? Okay. And which country? Let me know if hear me. So I've not seen anyone. Total. Someone typing something here. Let me see. Oh, good vibes. Hello, you are well. Good, loud and clear. Yes, amazing. We have Wachema from Uganda. Thank you so much for listening. Thank you so much for tuning. Please, guys, let me know where you are from. We have Kobe here from Ghana. We have Mexico guy here. It's called Hernan from Mexico. We have Michelle from Belgium. We have so this is Hamster Coin, please. Okay, Nigeria, Pascal, OT, we can hear you. We also have Bolochi from Pakistan. Kenny from Nairobi, Kenya. Amazing. I'm actually very, very excited for this session. So today we are going to go deep, guys. So for those who had joined our previous session, we talked about P2P trading. We talked about it was basically all about Binance. So if you missed that session and you want to learn, please, you can just go to the YouTube and you can be able to get that session. So I'll be dropping the link for that session here so that you guys can be able to catch up. So for those maybe who had missed the previous session, which we did on Sunday, it was just about Binance Exchange, how to open your account, how to open your first trade, how to buy. Okay, we did a live transaction of buying and also selling on Binance P2P. Okay, and so we learned so much on Sunday. So today, guys, we are going deep. Okay, we are going to dive deep. We're going to learn about futures. Okay, we're going to learn about margin trading and how do you take advantage of leverage to make exponential potential of income. Okay, so we are live. Okay, and so we're going to introduce my guests in the room, and then of course I'm going to go through some housekeeping rules, and then after that to I'm going to announce some very, very amazing things happening today. Okay, cool. So let's start with my guest in the house. My friends, please introduce yourself. Can start with Felix.
So hey guys, my name is Felix, Felix Gitao. I'm from Nairobi, Kenya. Okay, I've been a trader for the last 3 years also, and my main specialty is actually futures, margin trading, isolated and cross, and I've also done some spot trading, and my main platform is Binance. I'm glad to meet you guys. Glad to be here.
Amazing,
Welcome on. Yeah.
amazing. Thank you so much. And we have another guest in the house, Kenny.
Okay. Hi guys. Good evening. It's evening here in Nigeria. My name is Kehinde Lawal. You can call me Kenny. From Lagos, Nigeria. I'm also a trader. I've been trading for the past 3 years as well. My main specialty is the spot market, the margin market, and I'm also excited to be here to share knowledge on how to go about trading margin on Binance. And I hope today's class is going to be useful to the learners, to the students. All right.
Great, amazing. And I'm your host, Mwakisha. Okay, Mwakisha Judge. That's my name. My social media handle is at Mokiganga. You can see it there. So that is on my Twitter, also on my Telegram. You can also, chat me on those lines. So feel free to connect on socials so that we can keep this conversation going. So, guys, I'm actually so much excited today because we have so much lined up for you guys. We have amazing giveaways. Okay, over $1,500 worth of giveaways, for you guys, especially those who are going to stick with us to the end. And actually, guys, if you are going to be among one of our top three selected winners, you'll also get there's $500 to be shared. Okay, among the top three winners, there's $500 to be shared among 10 people. Okay, so 10 people will be winning. Actually, 100 people will be winning $10. Okay, in $1,000, and then three people will be winning $500 among you guys. So I'll be giving you more information as we go along. So for those who are going to stick with us to the end, okay, for those who are going to get the knowledge and be able to stick with us to the end, I'll give you a special form. It's going to be a Google form. You guys are going to fill that form, and then once you fill the form, we will be selecting winners from there. All right, and basically that's about it. And let's get ourselves started. So roll up your sleeves, guys. Roll up your sleeves because for those who had attended our previous session, we had talked about, went a bit deeper on the Binance exchange, the ecosystem, and what Binance is all about. And also we brought you all the way to P2P trading, how you can buy your cryptos on Binance. Okay, so we showed you all that. And for those who will have missed that particular session, please, you can go to our YouTube channel, our Binance YouTube channel, and type all about Binance, how to make money trading. So this is the second session, or rather we can call it the second episode, whereby now we are going to the next other products. We had talked about other products in the previous session. So here we'll be talking about margin trading, also we'll be talking about futures trading and what these are all about. So most guys have been asking, especially I've been following conversations on Telegram, and people have been asking, we need to learn about margin. We want to understand how do we use leverage to make money with these margin trading. And with that alone, we decided to put up this session for you guys so that we can be able to learn together. So with that, further ado, let me share my screen quickly, and then we'll be going through some slides, okay, which are going to help us, have that rough idea of what are these terminologies we're talking about. All right, so let me do that quickly. I hope you can see my screen. And I'm going to give this over to Felix. Please go ahead.
So hi guys, welcome again. So I'm going to be presenting the presentation today about how to trade margin and futures on Binance exchange. Okay. So I'm going to please just move the slide to the next page.
All right.
So I'll start with margin trading. So basically, margin trading is a method of trading assets, in this case, cryptocurrencies, okay, using funds provided by a third party, thereby allowing the trader to get greater sums in trading capital. Ideally, it does amplify a successful trading, results by the leverage factor. Okay. So what this means, if I can explain in a layman's language, if say you're trading a capital of $100, okay, and you want to leverage it to a ratio of 5:1, okay, ideally you'll be trading $500 instead of your $100, but $400 will be in borrowed amount, okay. So It is important to note that leverage describes the ratio of borrowed funds from the margin, okay? And it also, margin trading and futures do have the chances of getting liquidated, which essentially means that when an exchange, forcefully closes a trader's leveraged position due to a partial or a total loss of a trader's initial margin. Initial margin being your initial collateral, okay? Your initial capital. Like I explained, say $100 and you leveraged times 5, so you trade in $500, and let's say you make a loss of $100. So the exchange will not want to go at a loss in the money that they lended you, okay? So what the exchange automatically does, it will liquidate you, allowing the exchange to take back its capital, okay? So yeah, so please just go to the next slide, okay? So there are two types of margin trading available on Binance. Yeah, George, I don't know if you can shift over to the next.
You can see my screen.
Screen.
Which one do you see?
Yeah, I think I lost you guys. Anyway, so there are two types of margin trading available on Binance. Sorry.
Yeah, go ahead, Felix. We can hear you.
Yeah, you're cutting off, literally.
Hello, Kenny. Can you hear me? Hello, guys. Okay, I think Felix has an issue with his network. Okay. Kenny, would you like to pick it up from there? Okay. Sorry. So Felix, you're back. Can you hear us now?
Yeah, I can hear you. I don't know what happened, but
okay.
Yeah, I was on slide 3.
On this part.
Yeah, so as I was saying, there are two types of margin. Sorry, there are two types of margin trading available on Binance. Okay, so one of them is cross margin and isolated margin. Okay, the difference between the two really is that in isolated margin, mode is independent of each pair, which means that if you choose to trade in isolated margin and you choose the pair of, like, let's say Bitcoin versus USDT, okay, you'll not be able to leverage any other, let's say, coin apart from the pair that you've chosen to isolate margin in. Also, the risk and depth is isolated, which means in a situation whereby, let's say you get liquidated, okay, and you have more than one position in your different accounts or in isolated margin, only that single account that has been exposed to liquidation will be affected, okay? Also, something I should have mentioned, isolated margin does allow you to leverage up to 10 times, okay? Up to 10 times, and you can be able to open several isolated margin accounts. So the second one is cross margin. So it's just the opposite of isolated margin, whereby you are able to leverage different pairs using the same collateral, okay? So cross margin mode is shared among the user's margin account, meaning users can transfer in, hold, and borrow all the trading pairs in a cross margin account, and thus doesn't have to hold a single pair of leverage on it, which means, say, in the cross margin account, the pairs available are like, let's say BCH or Bitcoin, BCH, USDT, let's say Ethereum, Litecoin. You can hold USDT, okay, and just leverage or borrow for, let's say Bitcoin or Ethereum or Litecoin or any other pair that you choose to leverage on. But the only thing, the difference is that if liquidation happens to occur, then it does occur on all the open positions in your cross margin account. And on the other hand, you can only open one cross margin account and trade the available pairs. Yeah, I hope that makes sense. So on to slide 4. So the futures contracts. So in a layman's language, really, it's speculating on the future price of an asset. Okay, that's what a futures contract is. You are speculating that on a certain date, maybe in future, the price will be this, and you want to, buy a contract and sell at that price if the market, favors you and goes towards the direction that you predicted. So futures contracts are agreements that allow traders to speculate on the future price of an underlying asset. In this case, cryptocurrencies. Okay, so crypto futures are contracts that represent the value of a specific cryptocurrency. You do not own the underlying cryptocurrency when you purchase a futures contract. Instead, you own a contract under which you have agreed to buy or sell a specific cryptocurrency at a later date. Bitcoin futures contracts, for example, are a derivative product similar to traditional future contracts. Okay, two parties agree to buy. In this scenario, in Binance, it's yourself as a trader and the platform as Binance. Okay, to buy or sell fixed amount of Bitcoin for a specific price on a certain date. Okay, a derivative product, in this case, futures are derivatives. Yeah, so a derivative product is widely traded instrument in financial world whose value is derived from the value of the underlying assets. Okay, traders can use them to can you hear me, guys?
Yes, we can hear you. Can hear you.
Okay, yeah, I think your camera is just.
We lost you in a second, actually, but we can hear you. We could hear you from derivatives.
Okay, so okay, as I was saying, futures are derivative is a derivative product. Binance has several of them, but I'm just going to handle the futures. A derivative is a widely traded instrument in a financial world whose value is derived from the value of its underlying assets. So let's say Bitcoin is trading at, say, 60,000 or something, and you predict that next week or so it's going to be trading at 65. So you can buy a futures contract and, perpetual or quarterly and predict that, at this date, just sell it at this price. And if the prices will be at that predicted value, then your futures contract will close. So for example, a trader speculates that Bitcoin will rise in price, but is not sure of the outcome. Thus they allocate, okay, I should have mentioned this before I went at the examples. Traders use them to speculate on prices, okay, but you can also use them as a hedge. What a hedge is designed, I don't know if you understand, things like hedge funds and stuff like that. A hedge is designed to reduce your existing exposure to risk, okay? For example, if a trader speculates that Bitcoin will rise in price, but is not sure of the outcome, thus they allocate 70% of their portfolio to the longs. Longs means that the commodity will increase in price, and while allocating that percent maybe to the short in case the market goes against their prediction. So in this case, then they can have a stop loss such that in the end they literally don't really make a loss. Yeah, it's the beauty of hedging. So hedging is especially popular with miners, okay, who need to cover the operation cost because they really don't know where the underlying price is versus the expense of mining. So I'll go to slide number 5. So Makisha, I don't know if you can hear me. So there are two types of futures contracts available on Binance. One is USDS, the USD coins, okay, money futures, and there is coin money futures, okay. So they have key characteristics. For coin margin futures, the collateral has to be the coin, the cryptocurrency, okay? Maybe Bitcoin, Ethereum, say Litecoin, apparently Dogecoin, okay? And they are USDS margin futures, and Binance has 2, USDT and Binance USD coin. Okay, so they both have isolated and cross margins. Okay, and cross collateral, you cannot do that on the coin margin, but you can do it on the USD margin futures. Okay, by cross collateral means you can borrow another coin based on a different coin that you're holding within the futures account. Okay, so you're going to go to slide number 6. So coin margin futures contracts on Binance offer the following characteristics. So settlement is in cryptocurrency, as I mentioned. Contracts are denominated and settled in the underlying cryptocurrency. This eliminates the need to hold a stable coin as collateral. The other advantage of this is that, or maybe disadvantage, however you look at it, is maybe when you hold in USD in futures, when you hold the stable coin and maybe you don't have an active trade and Bitcoin is rising in prices, then maybe you'll be losing the value, or you'll not be getting the value as Bitcoin, rises in value. So yeah, so you are able to hold the coin as much as you are trading it in the futures, coin margin futures. Contract multiplier represent the value of a contract. So each Bitcoin futures contract represents 100 USD, while each Ethereum futures contract represents 10 USDs. So I think we'll be shown that when I'll show you that on the platform. But even literally what this means, if you choose a contract of one contract of BTC futures, you'll be ideally trading 100 USD worth of Bitcoin. Okay, and if you choose one contract of Ethereum futures, you'll be ideally trading 10 USD value in Ethereum. Okay, so for example, you have 1000 USD of BTC USD quarterly, 12.25. So this will be equal to 100 USD times 10 contracts. Okay, because it's one contract is 100 USD, so 10 contracts will be equivalent to 1000 USD. So, and the same case applies to Ethereum. So another thing is that expiration. So I'm going to explain this much later. I have a slide for it, but there are essentially 2 types of futures on Binance. Okay, so not 2 times per 3, but I'm going to explain perpetuals and quarterly. So perpetuals mean that they are continuous. They don't have an end date. Okay, but quarterly essentially mean they have a day that they do expire. Say in this scenario, maybe 3 months. Okay, yeah. So by quarterly, maybe half of the quarter. So let's say half a month. Okay, 1.5 months. I mean, okay. So I'm going to move on to slide number 7, and this one handles the USD's margin futures contracts. So the difference is that the settlements are pegged with USD assets. Okay, so contracts are denominated and settled in USDT or BUSD on Binance, and clear pricing rules. Each futures contract specifies the base assets quantity delivered on a single contract, also known as contract unit. So the thing is, with this you can just evaluate based on the USD value that you're trading with, and they also have expiration characteristics of being perpetual or quarterly. So yeah, so the main difference between USD margin futures and coin margin futures is that one use the stable coins and stable coin pairs of USDT and BUSD, while the other one you are able to trade the futures using the coins or the cryptocurrency coins, i.e. Bitcoin, Ethereum, there is Litecoin there, Doge, and many more in there. So slide number 8. So yeah, so what are perpetual futures and quarterly futures? So the main difference between the two is the expiration of the contracts. Okay, a quarterly futures contract allows a trader to buy or sell the underlying asset at a predetermined price before a specific period. In other words, futures contracts have a limited lifespan and will expire based on their respective calendar cycle. So it's not basically that you can set, okay, it's quarterly 3 months here, but you can set it for a month and it will just expire after a month, okay? So for instance, a quarterly future contract that will expire 3 months upon the date of issuance. What about perpetual futures contracts? These do not have expiration date, okay? They'll continue as long as you're not getting liquidated or, you do not close the trade, okay? So for example, let's say, as bullish as we think we are, Bitcoin goes all the way to 100,000, but one individual opens a quarterly futures with 3 months from the date of issuance, and another one opens a quarterly futures with 3 months, expiration date, and another one opens a perpetual futures contracts. They both go into a long, but Bitcoin takes 4 months, okay, instead of 3 months to get to 100K, okay? So what will happen is that both having a take profit or a close price of 100K, this will not wait for the 100K. It will only close as when the contract expires in 3 months. But the perpetual one will wait all the way, will continue until 100K, and that's when it will close. Okay. Yeah. So I hope the difference between the two is clear to you guys now. Slide number 9. So so that's all about margin trading and or basically what you will need to know between margin trading and futures contracts. Okay. So how to trade margin and futures? So with this, I thought it was best to first give the key terms to remember. So number one is initial margin. Okay, initial margin is the minimum value you must pay to open a leverage position. It backs your leverage position and acts as a collateral. Okay, so it's in the case where I was explaining, like you have $100 and you're trying to leverage this times 5. So your collateral is $100. So you have to make sure that eventually you don't lose $100 from your trading, your equivalent trading amount, leverage plus initial margin, so that you don't get liquidated or and you can continue trading the amount. As a matter of fact, if let's say you are trading $100 times 5, and then you end at a loss of $50, okay? So you still have a collateral of $50. So you still get to keep your margin of $400. That's how it works. So if you're able to overturn this and you are able now to turn it into profits, the good thing is any profits made out of your leveraged amount, you get to keep all the profits, minus definitely the fees and the trading fees. So leverage refers to the use of debt or borrowed funds to amplify returns from an investment. In this case, the margin. So don't get it twisted, okay? So it could amplify the profits and it could amplify the losses. It's a two-way thing. Sorry?
Yeah, go ahead.
Okay. So the other one is maintenance margin, okay? So this is the minimum amount of collateral that you must hold to keep trading positions open, and below which there's a risk of being liquidated. So as I was explaining, you have $100, you trade in times 5 leverage, you lose $50. So let's say the minimum margin that you should hold is maybe $10. Okay, so you still have an opportunity to lose much more if you keep making losses. But once you hit $10, you risk being liquidated. Okay. So another thing that you should note is that you can be able to you can be able to add on to your maintenance margin. How? Maybe you see that you're making a loss and you have an active trade and you probably forgot to set a stop loss. You can deposit more, on your trading account to bring down the liquidation price, such that if the prices will not get to that point, then your chances of being liquidated will be minimized. Okay. So liquidation. If the value of your collateral falls below the maintenance margin, as explained, your futures or margin account may be subject to liquidation. And liquidation, you can either lose, and that's the reason why they say it's risky to trade in margin or futures, because you can lose some or all of your trading, trading account value. Or, yeah. So I think in another slide, I'm going to talk about how to really avoid liquidations. So mark price mostly is in the futures. There's a mark price and there's a latest price. So the mark price is an estimate of the true value of a contract, essentially the fair price when compared to its actual trading price, so last price. So as I said, in futures, because you are predicting a price and the futures, they still, you should not forget that there are still tradings going on in the spot market, which really essentially prices the real value of a certain asset at the current trading time. So that's the introduction of a mark price and a last price. So P&L essentially just stands for profit and loss, and it can either be realized or unrealized. This is in futures too. So realized profit or realized loss is in a scenario whereby you've closed your position. Okay, so if you close your position in profit, then that is the realized profit. If you close it in a loss, then it's realized loss. On the other hand, when a trade is active, you are able to estimate or to see where your position lies. Is it in profit or in loss? That value is known as unrealized P&L, and it does variate, as the market moves sideways or up and down. It does variate. It depends. You could be in profit today, unrealized profit. You don't close the trade, and tomorrow the market goes haywire, and you have unrealized loss. Either way, when you close, you realize whatever the P&L side you are in. Okay. So another one is risk and risk management. So used to identify price, okay, liquidation price and favorable stop loss price. Okay, I'm going to explain what stop loss is. Liquidation price, I think I've explained that. Okay, usually using the percentage of the collateral a trader is willing to lose in a trade by dividing your maximum risk by your net target profit. So most traders say, like myself, I'll not want to lose more than 2% of my initial margin. Okay, so I'll always mostly have a stop loss, say 2% maximum of my initial margin. And please note, initial margin, not the leverage plus initial margin, because 2% of the leverage plus initial margin is really higher value, more than 2% of my initial margin. Okay. So risk and reward ratio. Essentially, this ratio tells you how much risk you're taking for how much potential reward. And there's stop loss. This is an offsetting order that exits your trade once a certain price level is reached, usually used in risk management. So as I was saying, say I don't want to lose more than 2% of my initial margin, so I'm trading $100. So 2% of $100 is $2. Okay, so I will not want to lose more than $2 in any trade in my $500 that I'm trading. Okay, so as I place the order, I'll place a stop loss. Calculatively, 2% or 2% below the market price. So say market price of no, not 2% below the market price. The price at which my valuation of $100 will only have lost $2. That's where my stop loss should be at. Okay. So another thing, our stop loss does or it safeguards you from being liquidated in most cases. Say we have a flash crash. Okay, it does happen a lot. Place where there is maybe a glitch on the exchange and boom, prices just devaluate all the way down to 20,000 from 60,000. Yeah, the liquidation is at 30,000. You definitely get liquidated. It's only second thing. So yeah, so it's very. This should have been in bold, and stop losses are important. So market order. So a market order takes prices from limit orders and let you purchase or sell an asset instantly at the best price currently available. So this is basically what do I say? Like going to a supermarket, taking something and paying the cashier and leaving. Okay, not waiting for prices to adjust as the market changes. Okay, and when you place a market order, you tend to pay higher fees. So it's one reason why most people or most experienced traders will avoid it. But sometimes it helps you when you want to really, when you're missing out on a trend and you want to jump into the market real quick. Okay. So limit order is an order that you place on the order book with a specific limit price and will only be executed if the market price reaches your limit price or better. So how do you say this? So the price of Bitcoin, say it's 60,000, okay, and you want to place a limit order. So you're hoping that the price will get to 59,000, say that. So you're going to place a limit order at 59,000, okay? So the moment, and this will definitely go to the order book and everybody can see it, okay? So your order will, mostly it will show like a small arrow where you open into your account and you'll see where your order is at, okay? That's a limit order. You'll have to wait until the prices get to that point. And the only disadvantage in this, one disadvantage in it is that you're going to pay lesser fees because you're essentially providing liquidity to the market. Okay, so there's that incentive by the exchange to bill you lesser fees for the trading. Okay, then there's a stop limit order. So so a stop limit order. A stop limit order is where you don't want your order to be visible on the order book. Okay. So the prices are at 60,000 and I want to place my order at 59,000, but essentially I don't want my order to be visible on the order book. Okay. So I'll place a stop limit, say at 59.99 or 59,500. Okay. And place my limit order at 59,000. Okay. So my order will only be visible on the order book when my stop limit is hit. Let's say in this case, 59,500. Okay. And then my order at 59, which will be a limit order, will be placed and will be visible on the order book. Okay. And when I say the order book, it's where you see orders that are being placed. It's that place where you see someone is buying 1 Bitcoin, 2 Bitcoin, 0.2, whatever, and the prices are moving to the current red, green, determining the direction of the market. So, in this case, there are two things: market makers and market takers. So, when you place a limit order and a stop limit order, you are a market maker, okay? And when you sell or buy at a market order, you're a market taker, okay? You're not providing any liquidity essentially, and your orders are being subjected to being completed instantly. Okay. Yeah. So those are some of the key terms to remember. They should help you, in which way to go. Place a market order when you want to really execute a trade real fast, so that you don't miss out. But when you want to execute a trade maybe next week or something, and you know that the prices will hit, then you can place a limit order. In this case, maybe next week you can place a stop limit order so that your order is not, helping other traders to know which direction you, to help them predict what other traders are thinking according to where the market is going to go next. So slide number 10.
All
So,
right. Amazing. Just before we go to the next slide, so actually the next slide is about practicals. Okay, it's about really practicals. So before we go there, let me just so yeah. So what we like to do, guys, because this session, you see, does not really require a lot of theory, but it requires a lot of practicality, because you need to see exactly what is an order book. Okay, how do you use an order book to select prices and so on. So it's usually amazing for us to usually do some stuff on the practical level. And before we go to that session, I would like to mention that by the end of today's session, we have some amazing giveaways to give out. And and those giveaways, we are going to send a link to the chat for those of who are going to stick with us all the way to the end. So you're going to have this link whereby you just input your details, like your Binance user ID. So for those who don't know how to get your Binance user ID, we'll show you how to do that. And then for those who are going to participate in the actual trading, you have a chance to win some amazing goods. Okay, so we're going to talk about that in our later session. But for now, actually, I'd like to say thank you so much, Felix, for that detailed introduction to some of these terms on futures and margin trading. What is margin? What is it all about? And so on. So right now, we want to jump in directly to a practical section, because we don't want to take so much time. So we'll be jumping directly. Kenny, I don't know if you are ready. I would like you to share your screen so that we can move directly to the margin session. So after Kenny has gone through the session, we'll have another session with Felix. So Felix, please stick around with us. You're going to show us exactly what are these perpetuals you're talking about. What are these derivatives? What are futures? Okay, you're going to now demystify those terms and bring it to practicality from Binance exchange side. So Kenny, over to you. Let me yeah, please, you can feel free to share your screen. Oh, Kenny, if you're speaking, actually you're muted. You can unmute yourself.
Okay, I'm sharing my screen now. I'm sharing my screen.
Yeah, cool. Go ahead.
Okay, I just did that now. Please, can you see my screen?
Yes, we can see your screen, your Binance account clearly.
Okay, awesome.
Yeah.
All right, can I go ahead, please?
Yeah, please proceed.
All right. So thank you, Felix, for that wonderful session. You've really done a great job. You've explained nearly everything they need to know about Binance margin and Binance futures. Okay. So I'll just take a step further to show them the practical aspects on the Binance margin. Okay. And I'll try my best to make it as simple and practical as possible. Okay. So the first thing you need to do if you want to access the Binance margin is to go to the margin interface. So if you are on the desktop device, you can go to trade at the top left, then you click on margin. Okay. Oh, it's not going. Sorry, this is not going. Okay, can I share another screen? I don't know why it's not
Yeah,
going.
you can unshare that one. We share another one.
Okay.
No worry.
It's going. Oh, it's not going. Okay, it's not going at my end. I don't know why.
Is everything okay on your side?
Okay, let me clear my Binance data. So
Okay.
I will log in again. Okay. Binance.
So as you do that, maybe we can so Felix, do you like to talk about something which maybe you have not talked about as Kenny is sharing it with me? So let me ask you a few questions, Felix. How long have you been trading futures?
So futures are maybe the last 1 year and a half. Okay, so
Okay.
essentially I started trading myself, trading using canvas. So basically, no capital, just reading stuff, knowing what happens here and there. Okay.
Yeah.
Then 3 years ago, I started with spot trading. I was using a platform known as 3Commerce. I think guys should check it out. 3Commerce is not a trading platform, okay? You use APIs. And then after spot trading, I started doing margin trading, okay? I started with cross, because cross essentially gives you a times 3, which is not so not a high leverage, but it just gives you a taste of what to expect.
Yeah.
Before moving to isolated, and then I realized, maybe I'm missing out something, and truly I was missing out something when I got into futures. So it's been 1.5 years so far. Yeah.
Ah, nice. So on your journey, like what have you, on your experience on trading futures, what have you come up with to say this is?
So the thing with futures, you have an ability to really convert small capital into a huge amount of cash.
Right.
But it's good to mention that the same way that you have an ability to make a lot of money, the same way you have an ability to lose. You don't even see a lot of money, but everything. Okay. So yeah. So the number one thing that I've learned is that stop losses are important in this game. Always know your stop losses, know your exit points, know your entry points, learn your trends, choose your technicals wisely, and don't ignore the fundamentals.
They say trading futures and margin trading without a stop loss is like driving a car without brakes. What do you think about that?
Absolutely. Let's give a very good example. So recently, forget about the China ban and all that. Recently, Evergreen, the country, the company, I don't know, infrastructural company in China, it was crashing. The stock markets were crashing. Bitcoin was on its way up. Like yesterday, we were seated somewhere enjoying the markets and saying, this is going up, this is going up. And you go to bed the next morning and there's a crash. You are trying to, because the technicals were all saying, the direction is good. You need to find out that, something is happening globally, and anybody who does not have a stop loss, as a matter of fact, was a victim, got liquidated. Okay.
Wow.
So again, let's say another one, the most awaited ETFs, right? So people bought the news. The markets was going up, crashed previous highs. But let's say you didn't have a stop loss, yeah, and you bought at the top. So right now it's a loss. Okay, so the one thing that I've learned is the importance of stop losses. They're important. Don't feel as if you're going to lose capital when you place a stop loss and it's hit. Okay, as a matter of fact, you're saving yourself from losing your capital. Yeah. The other thing that I've learned is to not trade inside channels. Okay. Yeah. So say we have a descending triangle, there's no breakout, and you have an ascending triangle, there's no breakout. And then you just enter a trade because you think that a descending triangle will break out upwards. Okay, so it breaks out, maybe it's a fake out, you don't have a stop loss, boom, you're crushed. Yeah. So trading inside channels, I'll totally absolutely discourage that. And another thing is, as much as, what do you call them? There's a weekly, the ranges, the time ranges, weekly, daily, hourly, whatever.
Weekly swings and monthly swings.
Yeah. So, as much as you want to trade on low time levels, yeah, they are good to see, to maybe get a hint of what is happening. Just avoid low time levels. That those hourly 45 minutes, they really mess you up. I tried that, and they really, unless you're a very good scalper. A scalper is someone who is really not looking to make huge profits. They just want a 1%, 2% over and over again. Okay. So yeah, so ignore those. Go to higher timelines. Okay? Time intervals. Okay.
So do you recommend newbies to start trading futures?
Do I recommend you? Most definitely, but with an option of not leveraging too high. Okay, and I should mention that Binance is awesome. There's this thing called grid trading that most people are unaware of. Okay, so what a grid does is it divides your chart into levels. You know, into categories. Say 2% intervals. Okay, so you set your buys, your sells. So if a newbie is trying to really start, that will be your starting point. So that you get the you know the handle of how this happens without you having to do much because everything will be automated for you.
I mean,
Yeah, yeah.
amazing,
So
amazing.
yeah. But otherwise, once you're good with it, you can do as much as you want. It's an awesome opportunity. It's an awesome
Okay.
opportunity.
So I
Yeah.
think we can. Do you feel like you're ready to share your screen so that we can proceed with you?
Yeah.
Wait for
So
Kenny.
yeah. So yeah.
Okay.
Sure.
Please go ahead.
So let me see these. Will it configure if I move to my screen too? Let me see.
Okay, just click share.
Okay. Sure.
Then
It does have
I'll
that
be able
option.
to
Okay.
place
It
it on the
does have
screen
that
here.
option. I saw that.
Okay.
So hmm. so I'll be sharing my screen too, which has this. I don't know if you guys can see it.
Not yet. So if I can see.
Can you
Okay.
see it?
I think
You
it
can see it,
comes.
yeah?
Here we are. Yes.
Okay. Okay, perfect. So yeah, so the first thing with trading, this is my account. The first thing with trading is you first have to know how to transfer funds. So let's see. Just a minute, let me close this tabs. So yeah, so to open your the futures account, you have to go to derivatives. So you have two options. So they have many options here. I don't really use any of these. So the derivative there, go to USD. Okay, you can go there and you can go to coin futures. Okay, then you've got to transfer funds to it. I think I have some funds on my coin margin. So and what you should see is just give me a minute. It's loading. Something like this. Um, for the coin futures. No, for the USD, I think it's supposed to be pronounced as USDs, you know, like a plural thing, insinuating all these perpetuals that you have. And then there is the coin futures there. So I'm going to transfer some funds to. So when you want to transfer, you essentially just go to your wallet overview. You don't really need to go all over the place. Just hit transfer there. Okay. Um, so this thing is a slow load. I think we'll handle one at a time. So yeah, so you just hit transfer. Okay. Um, I know it's okay. So this is where you transfer your funds from different accounts. Okay. So from Fiat, let's say I want to send it to USD. I cannot send to the coins because I only have USDT in this. And you can send to Cross. Okay. So you choose Cross, you choose what you want to transfer, the amount you want to transfer. You can choose, you know, isolated margin. Okay. And you choose what you want to transfer to isolated margin. I think by now you know when you transfer, like say, ADA or Cardano to isolated margin, okay, you can only trade transfer 1 inch or Bitcoin, I can only trade Bitcoin pair, okay, in isolated margin. And I can only borrow Bitcoin pair in isolated margin. That's what I was trying to explain before. And if I transfer to cross margin and I transfer Bitcoin, then I can probably borrow any of those coins available in cross margin. I hope now that makes more sense. So anyway, I'll be transferring to USD and futures, and I'll be transferring. So let's say I want to transfer 100 of them, and okay. So what happens is, you see up here, transfer successful, no charges, nothing, just moving forward inside the platform. The platform is different, or let's say, suppose. Then I should see my funds around here. Okay, so if I reload this page, uh-huh. It's really taking its time. So yeah, so you can see I have now available balance, and so what's next? What's next is that I choose what kind of a trade or margin trade I want to carry out. Is it isolated or cross? Okay, I turn to isolate myself. That makes sense. So and then I want to choose the leverage. You can go all the way up to 1.5, but this matters to your level of experience. For new traders, probably they limit the level at which you can margin trade. So for newbies, please just actually, if you are a newbie and you just train this, just don't leverage. Okay, just play around with your capital, because learn, then try maybe at times 2, times 3. Here you'll be yeah, you'll be good. So I'm just going to try at times 3 so that people go times 7. I like times 7 for some reason. So yeah. So if I open a trade and I choose, so I don't know if you remember, you guys, I was telling you. No. This is in USD, so it doesn't really have the count. So in BTC, just a minute. Suppose I'm not logged in or something. So so as I was saying, there are 3 ways to place an order. There's a limit price. Okay. So if I place a limit order at 57,000, okay, my order will only, okay, let's check this order book. This is called an order book, as I was saying earlier. These are the open orders, or the orders are waiting to be completed. So you can enlarge the buy orders by clicking that point there, and you can come all the way and check your order book, see where people think the prices will be at, by checking the size and the summation. See the size here, you see. And you can actually, if you are good in analyzing this, you can literally almost tell where people, where the illusion people are getting that the price will go. And here are the sell orders. Okay. So I'll just place an order within, and you'll see how your order should present itself. So let's go to a buy and the order book, and I don't want my order to be closed, so I just choose it down 59,800. So I hope that will be within range. Let's say 59,850, 58,850. Okay, so 58,860. And then so I can choose how much of my leverage I want to use. So let me show you this in a layman's language. I'll just open my calculator here. And also Binance data. calculator. If you click here, you'll see. I'll come to that. So anyway, so I want to open a margin. Essentially, I can trade up to $700. Okay, if I choose 100, around 696, $4 less for whatever reason. So, but to just reduce my risk, maybe I don't want to trade the whole margin. Okay, I want to remain some capital. So let's say I still want to trade my $100, but have my my capital, available capital to open other trades. Okay, because I'm in isolated margin. So let's do 100, something there, 103. Okay, and I'm definitely buying what. Okay, this may be alone. So just so yeah. So the other thing you need to note is the last price. As I was saying, the last price is the price, the market value. Okay, not the mark price. Okay, the mark price is the fair value. So this last price is essentially this price that will always be here. So but because I want to 58. Did I say? So there you go, and I buy along. So what happens is that order is admitted, as you can see there, and it goes to open orders. Okay, so I have a limit order, okay, at 58,860. So should the price hit 58,860, then my order will be completed if the liquidity is right, which is almost always right on Binance. Actually, not almost always. So if you want to see my order on the order book, I should scroll all the way down. It seems like I placed it above. See, markets move really quick. So it's not even visible because it's not. Yeah. So I hope that makes sense. Okay.
Yeah,
But
that
it
actually
should,
makes a lot
if the
of
price
sense.
comes. Yeah, it's not visible because the last order here on the market book is or the order book is 58. You know. Okay, so on the other hand, I want to place a market. So market will not even give you an option to determine the price, will just determine. So let's say I just want to buy what 20, just the opposition. Sorry, whatever that happened. Minimum quantity 59 USDT. So let's do this. Choose 9% and a market. Market will close 59. The hell are this? Okay. This will be bad. So see, it essentially closes instantly and I have a position. Okay, see that? Then there is a stop limit. In stop limit, so I don't want, okay, this order here, eventually when if the market goes down, it will be on the order book. And as a matter of fact, there are tools to view much larger order books. So if someone is really studying the order book, they can access those tools and they'll be able to see all those, limit orders that I'll place. So they'll be able to, I'll be part of that, of their data. Okay, they'll be thinking, okay, this guy thinks that the prices will be hitting this price at some point. I'll just go ahead and close this at a 0.18% profit. Then stop limit. So I don't want my order to, okay, that disappeared. I don't want my order to appear anywhere on the order book unless my stop limit is hit. So I want to place my order at 58,800. Okay, I want to buy at 58,800. Okay, but I want to buy only when 58,800 is hit. Okay, and I want to buy 70% of my leverage, which is around 509. Okay, so what happens is when okay, doesn't have to be my stop price, so I can put maybe 58 just to be above. Okay, if you put it below, then you'll be disadvantaged yourself sometimes. But you can put it either way, either side. It will just obey your rules. Okay, so 58,900. Let's do 50. Let's see, buy long or buy short. Buy short, buy long, doesn't matter. So order is submitted. So
Can you please explain
see
to
here.
us what is this buy long and buy short? Sell short,
Oh,
buy
okay. So
long.
okay. Sure. So when I say buy short, no, sell short, I'm essentially saying that Bitcoin will fall at a price. So I'm saying sell this Bitcoin at this price because it will go down and you can buy back later. You can buy more Bitcoin. So I'll be relatively short in Bitcoin with an expectation that it will go down. Okay. So it will be cheaper. Essentially, remember, you're not really buying Bitcoin in this case, you're buying a contract. Okay. So essentially, the contract will be that Bitcoin will be cheaper at this point in time. Okay. So I'm shorting it. When I long, I'm essentially saying buy this Bitcoin at this price because at another point in time, it will be higher. It will be higher than 59,000. Okay. So say it will be 60,000. So buy long. So buy long, sell it at 60,000, which is a profit. So say sell short. So sell short at 59,000, buy it back at 58,000. You see? If you get the notion is that the amount of Bitcoin you sold at 59,000 versus the amount of Bitcoin you're going to buy back at 58,000, the amount of Bitcoin will be more, right? And if I buy long at 59,000, okay, and sell it at 60,000, the value of Bitcoin I'm going to sell at 60,000 will be more. Okay, so that's how you make profit when the market is moving both ways. Okay, I hope that makes sense.
That makes a lot of sense. So what you
Yeah,
have shown
so
us here
as I was
is
explaining,
estimated margin, right?
yeah, this is
Hello,
sorry,
you can hear me? Yeah. So
yeah,
what you have shown us
what I've
here
shown you. Yeah,
is isolated margin.
yeah, this is isolated. Yeah, this is isolated.
Okay, cool.
You can
So
just change it from here. Okay, it's really
mm,
not difficult. Okay,
yeah, actually, I want Ken
yeah,
has is back to us. So I'd like him to show us
okay,
how to do
okay,
cross margin, and then now we can come back to you. You show us how to
okay,
open
sure.
perpetuals and futures. All right.
Okay,
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 cool.
perfect.
So Kenny, are you ready? Is your network okay now?
Yes, I'm ready. My network is okay now. I'm ready.
Okay,
So
cool. Please
let
share
me
your
just
screen and proceed. So just start from
Yeah.
cross margin. Want to know? Just explain to us from your own understanding what's cross margin, and feel free to share your screen.
okay. Um, okay. 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 Can you see my screen, please?
There it comes. Yes, there is a screen.
Okay. Okay. So this is the Binance margin interface. So if I scroll down, sorry. If I scroll down, I have cross and isolated here. So cross simply means that you are putting down a margin. In this case, the margin is a collateral. You are putting down an amount, and that particular amount you can use it to service all the trades that you want to make. So let's say you have $500 in your trading account. You can use that $500 to service all your trades. So it's going to be the collateral for all the trades that you're making. So what that means is that uh, if the market should go against you, should go against your position, you can actually lose all that amount when you're using a cross margin. Okay. But when you're using an isolated margin, it means that out of the capital that you have, you are isolating a particular amount for that particular trade. And that's the maximum amount that you can lose. So that's just the difference. So let me quickly show you an example. Yeah. So this is a BTC USDT trading pair. So for example, if I want to trade cross margin, what I need to do is just transfer a collateral to my cross margin account. So let's say I'm transferring USDT. Let's say I'm transferring 50 USDT. Okay, so with this 50 USDT that I've transferred to this cross margin, if I'm on a 3x, the leverage here is 3x. That is, I can borrow or trade with 3 times my initial collateral. So if I'm doing 3x on this $50, 3 times $50 is $150. So I can trade any asset that I want to trade with the $150. That's for the cross. But for the isolated margin, I will need to trade only a particular trading pair, and I would deposit an amount, a specific amount for that trade alone. I don't know if I'm communicating. I don't know if you understand me. So the difference is just that cross uses all your capital, all your balance, all your collateral to service the trade. While in isolated, you are isolating a specific amount, and the maximum amount you can lose in an isolated margin trade is the amount that you have isolated for it.
Hmm. Makes sense. Makes sense.
Okay, so I'll just do a quick trade now, so you see. So to get to the margin interface, the first thing you need to do is click on margin, come to trade, come to the trade tab at the top left, then click on margin. So once you click on margin, you would see this interface, and next you need to choose a trading pair. So in the financial market, the trading pair is just a combination of two assets. You are trading two assets. That's what the trading pair is. So one pair is pegged against the other. Okay. So at the top right, you can choose the trading pair of your choice. But for newbies, I always advise you start by trading USDT pairs. That is market that are paired against the USDT. USDT is a stable currency. Is equivalent to US dollar. Okay. So and the reason I'm suggesting newbies should start with it is that you can easily know whether you are making more profit or you are losing your capital. Okay. So let me choose BTC. Okay, I'm on BTC USDT. Okay, let's go. Let's choose Ethereum, ETH USDT. So this is a trading pair. The first crypto asset that we have here is usually called the base currency, the base, which is ETH, and the second one, which is USDT, is usually called the counter or the quote currency. So in this case, we are quoting Ethereum in USDT, and that's the price that we have here. The price we have here is the price of Ethereum in USDT. So that's the trading pair that I'm going to be choosing. So once I choose that trading pair, this is an isolated margin, right? So if I want to fund my isolated margin to trade this, I need to transfer. I need to make a transfer. So I'll click on transfer here. So let me transfer about $30. Okay, so I haven't transferred $30 here. The isolated margin that I have here, the leverage here is 10x, which means that I can trade with 10 times my initial margin. So since I have $30 here, if I want to borrow, I will come to borrow. Right, this is the easiest way to do it. We have two ways to borrow. So I'll come to borrow. What will I be borrowing? I want to borrow more USDT, right? So currently we have tiers. For you to borrow, imagine we have tiers. We have tier one, tier two, tier three. So depending on your tiers, that's the maximum amount you can borrow. So for this tier, for this tier on this trading pair, I can borrow maximum of $270 using my initial margin of $30. So I'm going to borrow it immediately. So let me click on mask. That's maximum. So depending on your tier, you might be able to borrow more than this or borrow lesser than this. Okay, but I know that if I have $30, 30 times 10, is a 10x leverage. 30 times 10 is $300. Okay, so if I'm borrowing 270, okay, let me click on borrow. So as you can see now, I now have $300 here. But since it's an isolated margin, I can only use this amount that I've borrowed to trade only at USDT. It is not cross. So this amount I can only use it to trade at USDT. And as as Felix have explained, we have various other types. So I will quickly go ahead and use a limit order to buy, right? So, but before then, I just want to make I want to give you a tip, a quick tip that would really help you if you are going to be trading margin. And the tip is that depending on the position that you are going for, you can either go for a buy position, which is buy position is that you are buying that particular coin and you expect it to what, to go up. That's a long position. You can go for a long position or go for a what, a short position. Short means, okay, you are selling that coin at a particular price and you're expecting the price to drop, so that when it drops you can buy back and you make some profit. Okay, so I know Felix will still go in depth on long position and short position. So but the tip I want to give you on the leverage you are using, if you're using a 10x, divide this leverage, divide 100 by your leverage amount. So if I divide 100 by 10x, which I'm using here, that is 10%. So what that means is that the if I go into this trade and the market goes against me, maybe I go on a buy position, I want price to rise, and instead of price rising, price starts falling. If it goes against me up to 10%, I'm going to be liquidated. That's like the easiest way to know when you're going to lose all your money, when you're going to lose 100% of your money. So if you're on a 5x leverage, for example, if you divide 100 divided by 5, that is 20%. So if there's a price change, if there's a change in price of up to 20%, then you're going to be liquidated. Another example is a 3x. If you're on a 3x leverage, that means you are trading with 3 times more than your initial capital. When are you going to lose all your money? You're going to lose all your money if you divide 100 divided by 3, that's like 33%. When there's a price change of 33%. And if you're on Binance, if you come up, you can see the daily price change. Currently, HUSDT has, I'm trying to check at the top. The 24-hour price change is about 4.23%, 4.26%. So, so anyway, let me quickly enter into a trade position and show you how I place my own trade. Okay. Sorry, it's a bit noisy. Um, okay, please can you hear me now? Hello.
Yeah, I can hear you well.
Okay. So as I was saying, I I want to show you how I place my trade. Most times I always go on a long position. I always buy. I don't short the market. That's the kind of trader that I am. So a long position means that you're buying and you're expecting the price to go up. So that's the kind of trader I am. And before I buy, I always wait for a retracement in the market. That is, I wait for price to fall. So the kind of trader that I am, for me, this is a good time to go on a long position because price dropped today by about uh, 5%. Bitcoin dropped by more than 5%. Ethereum dropped by about 4%. So this is a good time for me to go on a long position. So I'll be buying. So for me to buy um, Ethereum, so I will go to a shorter time frame so I can really see what's happening. Okay. So yeah. Then if you want to do anything like technical analysis, if you want to do technical analysis, which is looking at the charts, you can switch to a trading view chart. You have trading view here. The trading view chart allows you to do some drawing on your charts and really understand where we have the support and resistance, right? So okay, okay. I'll be buying Ethereum with the money that I borrowed. Okay. So now let me start with a limit order. A limit order means that you are buying at a specific price. You are choosing your own price, right? So the current price is $4,000 for Ethereum. If I'm willing to wait, if I don't want to execute my trade now, maybe I'm willing to wait and buy at this lower point, which is 3,948. So I can decide 3,948. I can decide to choose that price, 3,948. Then let me buy with 25% of this capital. So I sent in $30 and now I have $300 because I'm using a 10x. So let me buy. Okay. So immediately I place this order, you notice that it's an open order, or otherwise called a pending order. So price will need to fall to 3,948 for this trade to be executed. That's a limit order, right? So, but let's say I want to enter immediately, like I want to buy immediately. So I can cancel this and choose a what a market order. Market order is going to execute it immediately. It's going to execute it immediately. So let me buy with 100%. Most times when I borrow, I usually use maximum of 50%. So right now I've borrowed about $300. I won't use all this on buying this because price can still fall further. Okay, so let me click on buy. I'll be using a market order which is going to execute immediately. Okay, so after I've clicked on buy and I've bought Ethereum. The next step which you must do is setting your stop loss. So as Felix have explained, that is under risk management. So always set a stop loss after you have executed your trade. Okay. So how do you set the stop loss? You use a stop limit order. This is a stop limit order that we have here. This is a stop limit order. So you can as well use your charts. So I just entered right now at about $3,997. So and as a the kind of trader that I'm going on a long position. I want price to increase. So let me use a forecast. So I'm expecting price to go up, right? To go up. So but if price didn't go up and price is coming down instead, if price is coming down instead, then I need to set my stop loss. I need to set my stop loss. Okay. So so now I'll be setting my stop loss. So if you can see this blue line that I drew here, that's like a support for this chart that I am. So if the price should keep falling and break this support that is going lower, then based on my analysis there, it means the market is going down, and I want to exit this trade at exactly this point. Okay. So and that's about 1%. This is 1%. This is 1%, right? This is 1%. So you can as well decide to shift your stop loss to 2%. um, Let me enlarge this. You can decide to shift it to 2%. Okay. So okay, this is about 2%. That's at 3,924. Okay. So for my take profit, I can decide to take profit at this high. If price should come up from this point that I bought it to this place, which is about 7.33%, I can decide to take profit. Um, okay. So this is for long position setup. Long position, that means you are buying and you're expecting price to go up. So let me show you how to set the stop loss. So for you to set a stop loss, you have bought already. and you now want to set a stop loss. So you come here, you come to the sell side. So I'll be using a stop limit order, right? I'll be using a stop limit order. So for the stop limit order, we have the first thing that we have here is the stop price. So the simplest definition of the stop price is like an alarm or a trigger. So it's going to trigger the stop limit order, right? So now, if the price is going to come down, I want to sell at 3948. That's the price I want to sell, 3948. The price here. So my stop price, which is like an alert or an alarm, is going to be slightly higher than the exact price I want to sell, because crypto is a very volatile market. It's most likely that it gets to my stop price and it doesn't get executed. It gets to my limit price and doesn't get executed. Okay, so my stop price, I would put it at 3950. Okay, because of limited time, I'm just trying to explain as quick and easy as possible. Okay, while my limit price for the stop loss, the exact price, the limit price is the exact price that you want this stop loss to execute at. Okay, that's 3948.19, 48.19. Okay, so if the price should start falling and it gets to 3950, which is the stop price, it's going to trigger an alert and it's going to sell at exactly the limit price. Okay, so what's the condition I want to sell? I want to sell all the Ethereum that I've bought. Okay, so if you look at it now, if I'm selling all the Ethereum I've bought at 3948, as you can see, this is the total amount, right? So let me click on sell Ethereum. So you should read it again. So if you read the condition, it's saying that if the last price drops to or below 3950 USDT, in order to sell this amount of Ethereum at my limit price. Don't forget, the limit price is the exact price that you want your trade to execute. You are choosing your own price. Okay, so the one above is the stop price, the one below is the limit price. So I'll click on confirm, and that has been set. If you scroll down, you will see. If you scroll down, you will see the pending order. The pending order is there. If you scroll down, this is the pending order. So uh, if the price should start coming down and it gets to this point, it's going to take me out of the market. And that's the use of a stop loss. The stop loss is to reduce the amount of loss that you can incur on a particular trade, and it's very, very, very important. Immediately you enter a position, the next thing you should do is set a stop loss. So you can set it to maybe 2% from your entry. 2% is still a good amount. 2%. Okay. So what about a take profit? You what if the price didn't go down and hit my stop loss, but instead it goes up, right? So let's set a take profit. Let me show you how to set a take profit. Then I round up. Okay. So there's this particular order type available on Binance called OCO. That is uh, one order cancel the other, one cancel the other, right? So it's a way for you to set a take profit and a stop loss at the same time. Okay, so I'm going to cancel this. I'm going to cancel the stop loss I've set, and I will set a take profit and stop loss at the same time. Okay, so I'll switch to an OCO order, and the first price that you have here is the price that you want to take profit. Okay, so based on my charts, it's good to have in-depth knowledge on how to chart, how to use the different trading indicator. But this is not a class for trading indicator, so that's why I've just drawn a line at the top, which I want to take profit on this trade. Okay, and the particular price is 4297.55. Okay, so I'm going to scroll down and choose 4295.7, right? Then the remaining input that we need to do here is for our stop loss. We're setting a take profit and stop loss at the same time. Okay, and we already set a stop loss earlier. So the first thing is for a stop loss. The first thing is the stop price. Okay, so this is where I want my stop loss. This is the price I want my stop loss to execute at 3948.19. Is the limit price I want my stop loss to execute at. But the stop is going to be slightly higher than it, because if price is falling, price is going to first get to a price that is slightly higher before it gets to my what, my the limit price for my stop loss. And the reason is that if it gets to a price that is slightly higher, this limit price for my stop loss is going to be able to be executed, right? Instead of using the exact price. If you use the exact price, it's most likely price is going to get there, and because this is a very volatile market, it can just keep dropping, and um, the trade might not get executed. Okay, so let me set it at 3950. That's for the stop price. The alarm, that's like the alert, 3950, right? Then 3948.19, 3948.19. Okay, so let me explain again. This for the take profit. If the price should go up and I'm in profit, I want to close the trade here at this profit level. And if the price will start falling down and it gets to 3950, I want to close. I want my stop loss to execute at this stop limit price, right? So, and I will be selling all of it, right? So don't forget, I borrowed $300 and I've traded with half of it, which is $150. Okay, so that my $150, if I'm executing, if this take profit get executed, it's going to sell at $160. That's $10 profit. If is my if it's my stop loss that get executed, I'm going to lose a tiny amount. Okay, so let me click on sell. Okay, so now we have a pending order, we have an OCO order, we have two orders actually. So the first order here is the limit maker, which is the take profit. If the price should go up, it's going to get executed at this price. Then the second is the stop loss price, and the limit price for the stop loss is 3948.19. Okay, I know this is just a quick overview of how you can go about it. I will round up now by just giving some general tips that's going to help newbies, especially when it comes to trading with leverage on Binance. So the first tip that I always give is that it's important that most of your money should be in the spot market. Yes, and the reason is because crypto is a very volatile market, very volatile market, and it has an average daily volatility of 5%, an average, right? And I've told you earlier, if you divide 100 by the leverage that you're using, maybe 10x or 3x. Let's say you're using 10x, and you divide 100 by 10x, that is 10%. If something should go against you by 10%, you can lose all your money. So this is just telling you that the money you are bringing to margin, let it be a minute amount. Yes, I know you don't have I know most people don't have huge capital, but at least make sure that majority of your capital is in spot, and maybe 20%, maybe 30. Me, I 30. That's what I use for leverage trading, and the reason is just because it's not that things can't go against you. It will go against you, but what if you're not even online, or what if your stop loss doesn't get executed? Things like this happen in a very volatile situation. Okay, so if that happens, you're not going to be losing much, right? So, and the second tip is make sure that you're using personally I advise 5x or below. That's what I use. At worst, I use 10x. So I know we still have higher leverage, like 20x, 30x, 50x. Me, I don't use that personally because due to the average daily volatility of crypto, it's very risky. Okay, then another tip is that make sure when you make profit, try and withdraw your profit. Finally, make sure that you trade less. It's not about the number of trades that you make. It's not about being on your computer every day. It's not about taking 100 trades, right? If you make one or two trades based on the opportunity that you see, you can relax and wait for another trading opportunity, right? There will always be opportunity in this market, right? So don't make the mistake of making the money and giving everything back to the market because you are just eager to enter a trade every time, right? So those are the few tips I want to give the newbies. I hope you have been able to learn one or two things. Thank you.
Amazing, amazing, amazing. That was a really, really deep explanation on how margin trading works. And I see guys usually have a lot of questions. And before you go, Ken, please
Okay.
just stand by because I see I know we're going to give our audience time to give us questions. For all these you guys are trying to show them. But there's this question which I keep getting all the time. Guys keep asking me. I just opened my Binance account, and all of a sudden I have a 200 voucher asking me
Okay.
to, so, and also $500 voucher. So how do I go about it? And mostly this voucher is for margin trading. So what do I do to maximize the potential of that particular
Voucher.
voucher?
Voucher.
Yeah.
Okay. Okay. That's a very important question. And if I didn't answer it, I wouldn't have put justice to everything on Binance Margin. Okay. So the thing is, when you are using Binance Margin, uh, this money you are borrowing, you actually pay interest on it, right? It's not as if Binance is giving you the money for free. No, right? You pay what we call an hourly interest rate. As you can see here, if I'm borrowing Ethereum, this is the hourly interest rate. That is, every hour you get to pay this percentage on the amount that you borrowed, right? And for example, if it's USDT that I'm borrowing, you also see that it's also a different hourly interest rate. Okay, but this is what I would say. The interest rate is generally low, and you don't need to be afraid that, okay, what if the interest, I get to pay huge interest on my loan. Okay, so but from experience, when you start borrowing huge amounts, because sometimes I borrowed about $20 of recent, and when I was paying back with interest, I paid about $500 as interest, and that was because my trade lasted for about 3-4 weeks, right? So when you start borrowing large amount, the interest rate might be high. Okay, so now this is where the voucher comes in. This is where the voucher comes in. Now, if you have a 200 USDT voucher, it means that if you borrow up to $200, you are not going to pay any interest. That's what it means, right? We also have a $500 voucher. So if you borrow up to $500 and you are trading, you are not going to be giving any interest. And those vouchers actually have expiring dates. Most of them are for 7 days. So for a period of 7 days, you get to borrow, and you're not going to pay any interest. Okay. And finally, I'm sure you're also wondering, where is the money that you're borrowing coming from? Is it Binance that is borrowing you, or you're wondering where it's coming from? So Binance has this staking feature, or lending feature, right, where people subscribe to. So when they subscribe all this their cryptocurrency, that's what they borrow, those that trade margin and those that trade maybe futures, and the interest rate gotten is what Binance get to give back to those that are lending and are staking on the platform. Okay, so yeah, the interest rate is quite minute. You don't get to pay much, except if your trade extends for a very long period of time. Okay, thank you.
Amazing. Okay, cool. I think that is a well explained session for the margin side of it. I don't know if our users have any question for Kenny. Thanks, Kenny. That was deep. That's Victor. We have wonderful tips. That's Dominic right there. Nimefurahi kuona Tanzania mwenzetu. Okay, that is someone from Tanzania commenting in Kiswahili there. We have others. Yeah, so I think that was a good session on margin. So let me I would like us to quickly, not into so much practicality because we don't have a lot of time. um Felix, we'd like you to just tell us what is perpetuals, and how do you open your perpetual position, and how do you also open your futures position on the account, and what is derivative. So put all these together in one explanation, maybe 10 minutes, so that we don't take so much time for our users.
Okay. So derivatives really, you're trading an asset based an asset price based on its no you're trading an asset based on its underlying price. Okay, so you're not really trading Bitcoin when you're trading futures. You're trading its price based on what you estimate it will be priced at on a future date. Okay, so we have two types of I think I should share my screen.
Yeah, sure.
So yeah, sure. I think that's green one. So I don't know if you can see my screen.
Yes, there it comes.
Okay, sure, perfect. So someone commented that it was not clear. I hope it's clear now. So we have two types of futures. Okay, we have coin and you have USD futures. Okay, and in coin and USD futures we have perpetuals and we have quarterlies. Okay, so when you come here to derivatives and you click, you can right click on either. Okay, in USD futures, you only trade using your stable coins. Okay, in this case, we have an option to trade, the Binance coin. Okay, the Binance USD coin and the USDT coin. Okay, and also in futures BTC or rather USDT futures, we have two types of futures. We have perpetuals and we have quarterly. Okay, these are quarter. And if you see, this is 58. If you will see this, this is 58,800 something. Okay, but when you go to the quarterlies, the quarterly futures, yeah, that's contract 12 that one. Okay, its last price is 61.66. Okay, so you can see you cannot relate the futures prices with the spot market prices. Okay, you have to differentiate the two. Okay, and as I mentioned before, the futures which are quarterly mostly expire after 3 months. Okay, dividing a year in the quarter, it's like 3 months, 3 months, 3 months. Okay, and the perpetuals do not expire unless you close the trade yourself. Okay, so one more thing I needed to do here. In the perpetuals, you should really take note of this margin ratio here. Okay, if you decide to trade in the futures, keep note of this margin ratio, maintenance margin. I already explained what that is, and the margin ratio and the margin balance. Okay, what this entails is that if this margin ratio clocks 100%, you'll definitely get liquidated, and you'll be liquidated at 100% of your capital or your collateral. Okay, so I have a trade that is opening. So one more thing, for newbies who want to get into futures, the best point to start is right here in USD perpetuals or BUSD perpetuals. You have this strategy trading. Okay, especially this futures grid, and I'm going to just show you how it's set up. What you do is that you divide this grid. A grid is literally just dividing this graph into sections. Okay, you say maybe I want to trade sections of 1%. If market moves 1% up, sell. If market moves 1% down, you buy. So you choose your range. In this case, I'm going to choose 57,000 to 62,000. You choose the number of your grids that you want. Okay, and they can be arithmetic or geometric. Okay. So I'm gonna do arithmetic because it gives me that, that percentage, that profit that I can make per grid. Okay, so also you should look at the market and choose whether you are neutral. As a matter of fact, for myself, I think right now the market is really trying to find its price after hitting all-time highs. So I'm kind of neutral. Then you can choose to be long or short. Okay. Once you choose that, then choose your margin ratio, whether you want to be in isolated or cross margin. Okay. Choose what you want to go to. Anything works here, but be safe. Stay on the safe side. Okay, it's very important to be on the safe side. So don't go for higher margins unless you're that risk taker, but I don't encourage it. Remember, you should not lose more than 2% of your portfolio. Then choose what you want to trade. Initial margin, I'm just going to do 100% there. Okay. And the number of grids, you'll note something. The profit per grid, if I change this to 15, okay, my profit per grid decreases because the number of grids increases, and then the difference between two grid lengths then is much less. So I may put 10, I may put 9, any number counts. Okay, but I'll do 10 for here. You can do as much as 150 apparently. Let's do that. Then you can ignore all these, but you can put a trigger. A trigger is like when that price is hit, that's when the automatic trading. Remember, this is a set and run and forget. It's called set and forget kind of thing. Okay. So then I cannot create it. I'll come back to that. So let's go back to this. I need to show you people how to observe this section here. Yeah, it is. Just a minute. And it's taking its time. So also something you should note is that the same thing applies to coin perpetuals and and quarterlies. Okay, so the thing is the same thing that I'm doing with the USDs applies with the coin, but for the coin you only trade in BTC. Available balance will always be in BTC or any other any other coin that you choose here. Okay, there's a whole lot of list here that you can choose from. Okay, then play around with this, but always be on the safe side. You see, as a matter of fact, for Binance, when you exceed 10%, it starts giving you all these warnings. Okay, because your liquidation, if you can check here, there's a symbol for whatever you trade in. There's a size. Okay, the size is the whole your leverage plus your margin. Okay, and then there's the margin, which is your original collateral amount. There's a margin ratio, like the ratio between this and this. Okay, notional size is the amount that you're using to trade, not necessarily your balance, but what you chose to enter that trade into. Entry price is where you got where your trade, became a position, an open trade became a position. Okay, the mark price, as I mentioned before, is the fair value of the market. The liquidation price is what you should always check once your position is open, because it will help you determine how much of a loss if the trade goes against you. Okay. Return on equity or P&L, as I said before, it's profit and loss. Okay, it's there's always two of them, one that is realized and one that is unrealized. And here you can close all positions if you don't want to trade. So stop loss and take profit. Oh, someone asked if I do use trail stop loss and what it is. I think I'll take a second and explain that. Trail stop loss is whereby you want to trail a price by 2%. Okay? So you have this. This is your profit level. Say you enter this trade at 54K, so this is your profit level. But you imagine that according to how the trend is going, it may go higher. So you want to trail it at 2%. So what it does, when it hits your profit level, it goes down by 2%. And whenever the price goes up to 2%, it follows it. Follows it with 2%, follows it. But if it goes down at the level at which that 2% is being mitigated, the account the trade will be closed. Okay, so essentially a trail stop loss helps you probably make more profit than you would have made if the market closed higher than your predetermined um, level. So what is the margin ratio? Yeah, as I mentioned, if this hits to 100%, then you get liquidated. Okay. Maintenance margin, I always need for this trade here. Okay, for this trade, I'll need at least 0.24 USDT at all times in my account to maintain, this trade. Okay, and my margin balance is around that, and that's the reason why my margin ratio is so low. Okay, with this, don't exceed 30%. It will mess you up. So then, as you can see, as I was explaining before, there you go. The size and the margin, about times 7. Okay. The ratio, the notional price, no, the notional size, entry. Was a long, so I'm definitely at a loss. Okay, I hope that makes sense. And I'm going to market close this because I want to show you guys how to start for Nifty. So here it is. I don't know if you want to give me more funds. Yeah, so I think that part covers USDC. No, the coin futures area too. The same thing, literally. Okay, same thing, and also you can set take profit. See this section here, I just clicked here. This means TP means take profit, SL means stop loss. So I click that and take profit. Last price, mark price. If you put mark price, you might miss. It moves really quick. So last price will really ensure that you close it. Okay, so suppose I'm going for a long. Okay, and the size I want to go 100%. So from here I can calculate. Take profit at 65. You tell me that I'll make an 8.1% for long, and else it will tell me that I'll not make any profit for short because longing is expecting the prices to go higher. Okay, take profit, and then you can set the limit price of what you want to take. Say that is your take profit price, and you want to take it at 65,001. And stop loss maybe 2% below it. Okay. So one more thing I needed to really cover is this calculator. Very important, essential. Okay. This helps you to determine your liquidation price. Okay, your target price for whatever profit you want to make in your P&L. Okay? Or profit and loss. So suppose I have one Bitcoin quantity, which includes a leverage of 20, and my exit price is 66,000. This I use it, and I entered at 60.01. Okay, so I calculate that, and this will be the potential profit that I make. But my initial margin, which will be my capital, would have been 0.05 Bitcoins. Okay, the same calculator applies here, but in this scenario, it will give you in terms of USDT. Okay. So another way to use this is another way to use this is to check the target price. So I want a profit. I have an entry price of 631. Okay, and I want to make what 10% from the trade of a 20% trade rate. Okay, so what will be my exit price? It will be 60.332, such that if I come in here and I have to input the take profit value, this will be my value, and then I'll have made 10%. Okay. Then for shorts, you want to make 10% at this entry. It must be lower than this, okay, which will be 59, because I'm expecting to buy back at a lower price. Then the liquidation price, very important. Okay, there are ways. There's one-way hedge mode. I think I explained what hedge mode is, but one-way mode, and say cross oscillator doesn't matter, and do an entry price of 60. okay, and quantity BTC1, but I have a balance of 0.05. Okay, so this will be my liquidation price. Okay, so at all times I should not allow my trade to hit this because then I lose my balance. Okay, and you'll note something. If I do a 10 times leverage, okay, which will be like 0.05, okay, then my leverage will go down. As a matter of fact, if I do a times 10 leverage, okay, but I choose to maybe trade 70%, so 0.035, then my leverage even go down much further, but I'm still trading a very, a good quantity. Okay, so this price here really is to be kept far away from your trades as possible. Okay. Then here is the max open. The max open really is, say you are entering at 6112, and you have this. So the max open is at a leverage of 20 times. I can open up to 0.024 bitcoins, which is equivalent to 14 in terms of count. Remember, I said that 1 equals to around 100 USDT. So this is like 1400. Okay. Hope that makes sense. And the open price also is pretty much the same. So say Bitcoin entry price, I want to do 6112, and quantity I want to do 0.05. So average price will be that. Really, this can be anything. So it's not really essential, but these max open, liquidation price, very important. Target price, whatever profit you're looking to make, shows you your exit points, and this one gives you the best place to place your stop losses, and the P&L gives you an estimate of how much profit you're going to make. Yeah, so finally, Binance futures, and for newbies, this is for newbies especially. Then set whatever amount you want to trade, and set the grid here. I said let's do 58,000. Let's do 60 what? 60, 2000, and then let's do 10 grids. That's a 0.6%, and so this won't allow me to open. So yeah, then you can set a stop loss. A trigger price can be anything. If you want to really just get into the market, but you can leave it blank and then it will just open trades when it hits one of your grid lines. Stop loss, I really not want to make any losses with this. So you just set your stop losses at the lowest grid, okay, which will really close any trades, for neutral or any trades. So okay.
All right. Thank you so much. Thank you so much, Felix. I think we have so much which we want to share, but guys, I think without because of time, there's no way we can exhaust everything today. But I believe you guys have learned something new today, so it's going to be it's actually amazing. Guys, I would like you guys to stand by for questions quickly. So before we go to our Q&A session, I just want to point out that we have some questions here from our team members here, from our audience, I mean. So, but before we proceed to those questions and answers, I have just dropped a link to the Google form. I was informed earlier that you guys couldn't access it, so just check if you can be able to access it right now. So please fill that form for those who want to participate in our Binance futures, and we have some amazing goodies for you guys. So just stand by, and we will be showing you. Yeah, so make sure you put your right Binance user ID. So Felix, I'd like us to show these guys how to get their Binance user ID. So on your Binance exchange,
Sure.
just go to dashboard. Yeah, up here on the dashboard, you can see this icon here. Then you click on your email. Click on your email. I'll click on dashboard. Sorry, yeah, just click on dashboard, and then you'll be able to see your Binance user ID right there. Okay, so please just copy that Binance user ID. It's up here. Okay, so you can see it up here. Okay, like for Felix here, yeah, that's exactly the highlighted one. That is the Binance user ID. So please go to your exchange account and see if you can be able to pull your Binance the correct user ID, so that if we are going to award you, we are going to award you using your Binance user ID. And then so quickly though, so we like to just pick up some question and answers here. Some questions. We have guys asking. Um, okay, so I can see all these about the form. So some guy by the name Allen, he's asking, when you have been liquidated. Sorry, let me just. Oh, it's working now. Okay, so M Petero is saying it's working. Jackson says not yet. Please just refresh your page and try again. Yeah. So I want to pick some questions here quickly. Yeah. So let me go up here. Sorry, let me remove that question. Yeah, so this guy is asking, when you have been liquidated, how do you manage to pay money you borrowed? Okay, so this tells me that Alan, you have not understood what it means to be liquidated. So let's assume you have borrowed let's assume you want to trade $100, okay, and then you have borrowed X 10 times of that money. So how much money will you have? Okay, you'll have $1,000. Okay, so $100 times 10, so you'll have $1,000 to trade. So your fee will be $1,000, and that's exactly what you'll be trading. So if the trade goes against you 10%, okay, it is your capital which will be withdrawn first. Your initial capital of $100, that's what will be withdrawn first. So basically, the exchange has it's being safe by taking back its money. Okay, and then now you remain without anything. That means you are losing your entire capital if your trade goes against you 10%. That's why stop losses are usually very important, so that if a trade goes 3%, you should be kicked out of that trade. So instead of losing now your entire $100, you end up losing like $30. Okay, so that's how stop losses are usually very, very important when you're trading margin and stuff. Let me quickly pick up some more questions here. We have Victor asking, are there advantages and disadvantages of the two future types, that's quarterly and perpetual, or they are just similar the way with the difference in expiry? I believe Felix, you can pick that quickly.
Okay, so Victor, really, there's not essentially a depictable advantage between the two, apart from expiry. But as you can see, the prices do differ. Okay, so someone who literally is in trade for quarterly right now versus someone who is in trade for, perpetuals. For quarterly, they are in much more profit because the price is difference. Okay. So the main advantage is if the market is favoring, it's long and you're in long. When you're in quarterly, most often than not, you'll be making more money. So if you see it that way, then, well, yeah, there is that advantage. But essentially, there is no true advantage between the two. Okay.
So Evelyn also is asking a similar question. In the event of a liquidation, do you lose out? Let me just put this on the screen. In the event of liquidation, do you lose out on your initial margin only, or the whole amount borrowed liquidated too?
You don't lose the amount borrowed. That amount doesn't belong to you. You've been lended. So what you lose is your capital, but your capital plus, what are you going to say? So essentially, the liquidation point will also include the fees that you owe to the exchange. Those, as my colleague mentioned, includes the interest rates that you have to pay on the borrowed amount. Okay, and that's what will get liquidated. So what that gets liquidated is your initial margin, okay? But the borrowed amount goes back to the exchange. But you cannot borrow back the same amount unless you refill your margin to the, to the initial margin that you had. Okay, I hope that makes sense.
That makes a lot of sense. So, we have Queen Marcel here. Queen Marcel is asking, so futures allow traders to speculate on future asset prices. Interesting and quite informative class. Oh, so hers was more of a comment, not a question. So thank you so much for Marcel for joining the call. Let me pick an on from here. I think we had Kenny had actually talked about this, but how does he claim his 500 USDT voucher? And this is in regard to margin trading.
I think I'll leave that to you.
Yeah, so basically, how do you claim? You just need to trade. Like Kenny had explained that margin trading usually has profit, has sort of interest per day. The interest is calculated on a daily basis, and usually it's a small interest, but it's calculated on a daily basis. So if you want now to claim, means you have to now place a trade. It's like you have borrowed these funds, you have been given these funds to start or to open a trade. So you open your trade and now you start trading. So if the expiry of the voucher attains and you have made maybe some 50% profit or let's say 20% profit, that is your profit to keep. But now the voucher expires and the $500 is taken back by the exchange. All right. I think let me see if we can pick up a few more questions. A few more questions.
I think there's one who asked about trailing profits, not trailing
Yeah.
stop loss. I was hoping I
Go
would
right.
answer. I don't know if because
Yeah, go right
technically,
ahead. Pick
okay.
it up.
So trailing profits really. I'll just can I give me a minute? I share my screen and show them like what it means. Huh?
Yes. Let
Just
me
a minute,
just
just a
check
minute, just a
something.
minute, because I'll just put it. I hope you guys can see my screen.
Not yet.
So suppose
You're
I'm
ready to
trailing
share?
profits. Okay. Okay. So suppose I'm trailing these profits, my profits at 2.28%. Okay. So whenever the price moves up by 2.28%, which means it will be up there. Okay. My profit, my stop loss moves from this point here up to this point here. Okay. So the price starts playing around again and maybe moves another 2 point whatever percent, okay, or whatever I'm tracing, I'm trailing it at. So my stop loss again moves from here to here. So if the prices maybe play around this point here, but cross down um, my trail profit price, okay, my trade crosses, okay. So instead of making my profits at this point, I make them at this point. That is the advantage of trailing profits or trailing stop loss, essentially. And guys, a stop loss doesn't only mean that it's a stop loss when you are at a loss. Okay, you can place a stop loss when you are at a profit, which means you have higher profits, but the prices are going down. You don't want to lose much more of your profits, so you place a stop loss at a higher point than your entry point into the market. I hope that makes sense.
All right. Yeah, that makes a lot of sense. I think we are coming to the end of our session. And before we close our session today, guys, I'd like to announce to you that we have an amazing um, airdrop, okay, which is coming to you short. Let me see if I can share my screen. Let me see if I can get to share my screen so that you can see this amazing airdrop coming to you guys. So let me explain the airdrop. Binance, we're offering a 7-day airdrop challenge, okay, for you guys. So you just need to do a small trades on specific coins, that AXS, SHIB, and BNB. Okay, so you have up to $15,000 to be won. Okay, so to be shared among everyone. All you need to do is to participate. Let me just share the link on the chat section so that you guys can go through it, and then you can be able to participate on the airdrop. Let me close this window. Yeah. Any final words from you?
Okay, yeah. I think I'll just oh, someone asked trailing buying, trail orders. Same as
Mhm.
trail stop loss. Okay, trail orders, maybe you want to buy at 60,000, but you think the price will be going lower, so you trail it at 2%. So every time the price goes down by 2%, the buy price changes, okay, to that price. And if it plays around and goes up above your 2%, then it triggers the buy order. Okay. One more person asked how I analyze my charts, I think. So basically, no. Okay, there's just 2 minutes. I think I lost it. But basically, I don't trade within trends. Yeah, I only trade when a trend has been confirmed. And sometimes a breakout doesn't always mean that a trend has been confirmed. Okay, so go check out Baby Pips. I think it will have a lot of information for you to learn about trends. Indicators to use. Yeah, my best indicators are MACD, RSI, stochastic RSI, and momentum. Okay, I also use moving averages a lot. You guys go read about those, and something called a super trend. Super trend is something just amazing. Okay, go read about it. All this information is out there. Learn how to use platforms like TradingView, and Binance also has TradingView that is inbuilt. You don't have to really pay a premium account on TradingView because Binance will just give you access to just about anything. And learn how to draw your trends. A trend is mainly 3 lines, but you can draw when it's 2 lines, waiting for the confirmation of the third one. Never ignore a trend breakout, okay? And remember to have tight stop losses always. That's my best advice to you guys.
All right. Thank you so much. Thank you so much, Felix. And guys, I have shared a link to Binance Academy. Binance Academy is where you find so much materials for free. And all these materials, actually, we have derived them from our main portal of Binance Academy. So most of these things you can get them there. Just make sure you visit Binance Academy so for you to learn. And for those who have not filled the form, please make sure you fill the form. I've already dropped the link there. So fill the form so that you can stand a chance to be among the lucky winners. And I would like to say thank you very much for everyone who has showed up today for this session. And thank you so much for our speakers. You did an amazing, amazing job. We really, really appreciate you sharing knowledge to us. You are amazing, guys. You are really, really amazing. So from my side, I would like to say keep it Binance, okay? Keep it Binance, and let's keep rocking, okay? And don't lose. Yeah, I mean, don't over leverage. That now that you've learned how to trade margins and futures, just trade safely, be safe, and keep winning, guys. Keep winning. Let's take advantage of the market and let's keep making money. Cheers, guys, and have a good evening. And thank you so much again for joining our today's session.